Andreas, the two questions you're going to answer is that do you think frontier or emerging markets like Iran can have a unique model of financing? If so, what is it? And if no, why not?
Thank you very much for inviting me to today's conference. You asked me the question, do you think frontier or emerging markets like Iran can have a unique model of financing? And if so, what is it? And if not, why not? It's a little bit of a crystal ball question, but it depends also a bit what one is talking about. Are we discussing a model for investment or are we discussing a model for trade? Either way, the business has to make economic sense regardless of the market. We all are aware of that. Otherwise, you don't find a credit, you don't find an investor. Let me remind you of the three main segments of financing. There's corporate finance, there's project finance, and there's, of course, trade finance. Let's talk about financing and investment. Except for government subsidy levels, I don't see a different model for frontier markets, Iran, or the rest of the world. And even on the subsidy level, governments now in Europe, especially in these days of COVID-19, are very generous in providing support to business models or concepts. Let me start with corporate finance. Here, the balance sheet of the corporation is the basis of financing. Is the company strong enough to amortize an investment and the interest and to pay the investor or the shareholder back? Typically, in corporate finance, an investment bank, and I'm sure there are quite a few of the very good ones in Iran here on this presentation. These investment banks will organize capital in form of shares or a loan in form of a bond to finance the overall activity of the corporation and not a particular project or a particular trade. If we look at project finance, that is indeed about a specific project. And the immediate question is, what are the costs of the project and how are the returns paid? Because the only security of the project is the cash flow it produces. Costs on project finance, for example, in the oil and gas sector here in the country, could be financed with government help, as always, shareholding. And on the equipment, you would be able to get equipment financing or vendor financing. We'll come to this in a minute. I find this one of the most attractive solutions. Let me move to point number 3, the trade finance, where only the trade or the transactions are financed. As we know, the classic trade model are prepayments, letter of credit, and bank financing, where cash is exchanged against product, and then you have the compensation trade, also called barter trade, where products are paid with or exchanged against other products and not cash. Now, many might say or think compensation, barter trade is a thing of the past. That's absolutely true. You have the British merchant banks. Compensation is century old, but it is also still very attractive today as it was 50 years ago. One of the largest industrial conglomerates stated a few years ago in their annual report a line that is called non-cash trade as 30% of their sales. Non-cash trade is nothing else than barter. You take someone else's commodity or product instead of cash. So 30% of a multi-billion company is a very significant number. Non-cash trade is nothing else than compensating where the company sells a product, accepting others people's product instead of cash. You take food against industrial goods, or for example, you take marble, you sell marble, you take wood products or pharmaceutical, whatever it is. Let's assume that the seller sold marble against wood. If you're in the marble business, you're not in the wood business, so you need to find a buyer for your wood to get your cash back. Compensation has become a very large business worldwide. It's a very big industry. What's the advantage of compensation? The compensation enables the buyer to purchase a product despite the lack of cash or foreign exchange, and allows a seller to sell to a buyer who does not have money. Commercially speaking, I find it an extremely effective model, administratively and cost-wise. Different countries have different legislation and regulation regarding barter trade, so you have to check that. There's often politics and central bank thinking involved how to deal with it. But for example, my own country, Switzerland, has a very liberal view on it. Compensating trade work nationally between two companies in the same country, and they work internationally across borders. Let me touch upon vendor financing. When interest rates are high, importers often can't afford to borrow from the banking sector. And I'm sure you know what I'm talking about, sadly. If your seller is in a country with low interest rates, vendor financing is an exciting alternative, provided the transaction is secured. The essential advantage is that the buyer benefits from the lower financing rate in the seller country. This works for trade more than for investments. So if a European seller accepts to finance it, the European financing charges are quite low. I can also confirm to you that even today, Iranian letters of credit are accepted from some of the banks. We accept them also. Worth investigating. Another useful tool, a bit of an indirect vendor financing, is export credit insurance, which is offered by many governments, including Iran. Export credit insurance means that the seller's country's government insures the risk of non-payment of the buyer. But also an export credit insurance wants to be properly protected. Export credit insurance was broadly available after signing the JCPOA. We are sure that more countries will offer it again when there is hopefully some light at the end of the tunnel. Vendor financing is a very economical and cost-efficient way of financing if properly negotiated. A key difference between the international markets and local Iranian financing is the cost of funding. And often Iranian companies are required to have a higher level of share capital. On the other hand, isn't it better to pay the shareholder a profit instead of spending your revenue and pay high interest?
And how can international sanctions be simultaneously a challenge and an opportunity in terms of financing? Actually, I want you to actually consider the condition of our country in this era.
Thank you again. You asked me in this question, how can international sanctions simultaneously be a challenge and an opportunity in terms of funding or financing? I fear that overall international sanctions are financially and operationally much more of a challenge than an opportunity. I mean, this is what those who issue sanctions are trying to do. They try to strangle an economy or to hinder a person or a company to be operational. So any opportunity would only come out from avoiding something that shouldn't be there in the first place. The challenge lies in the significant increase in cost. We touched upon that also in the previous comment, because you have to source differently, you have to avoid sanctions, you can't do business, people don't want to deal with you for all kinds of reasons. From a country point of view, the opportunity that could be there is to render the country more resilient and stronger. And that's exactly what Iran has been trying to do the last years to make a resilient economy. One of the tools is to limit the imports, closing the borders for finished goods, and ask companies to produce locally. In moments of emergency, and sanctions are moments of dramatic crisis, closing borders to protect the local economy secures work, secures income, secures food on the table for the local population, and it secures income tax revenue for the government. All absolutely critical, as long as it doesn't become a long-term tool, because on the other hand, it excludes the market to get state-of-the-art product and technology that might be required to optimize a production process. Also, not every company, and in particular not every large company, can easily switch from importing finished goods to bulk or semi-finished goods. It's a very lengthy process. You have to qualify your producer. The opportunity maybe lies in third-party production companies who could get more business, but it's a very isolated advantage. All in all, I fear that the downside is much larger than the upside.